Hi, my name is Julie Asti. I'm a certified financial planner with Asti Financial Management, and today I'm going to be talking about how to hedge against inflation as an individual investor. One of the things that you're going to want to take a look at if you hold them is going to be your bond portfolio. Bond returns are going to be definitely affected by the rate of inflation. For example, if you have a bond that's paying 4% and inflation is running at 4%, your real rate of return is going to be zero. You're not going to be getting ahead at all on that rate of return on the bond. There's not a lot of control you can have over the rates that your bonds are currently paying, but one of the things that you can do is you can take a look at the duration of your bond portfolio, and duration applies to the length of time of the bonds. Bonds can range anywhere from short term, less than a year, all the way up to long term, which can be 10 to 30 years. So it tends to be that when inflation is running high, bonds that are longer term may be more affected than bonds that have a shorter term duration. The other benefit is bonds that have a shorter term duration, they're only going to have a set length of time, so the bond portfolio is going to be coming due more often, and therefore you can lock in at hopefully higher interest rates that will be more competitive with the current inflation environment. So you want to take a look at the duration of your bond portfolio. One easy way to do that is to invest in a bond mutual fund and research the duration on that bond mutual fund and have a professional money manager managing the duration of the bond portfolio on your behalf. One of the things you may want to do if you are an individual bondholder is take a look at TIPS, which are Treasury Inflation Protected Securities. They're offered by the U.S. government, and what they do, they offer you a base rate of return that's adjusted for the amount of inflation. You get a credit for the consumer inflation that's going to be on an annual basis. So you're in a sense going to be guaranteed a real rate of return that's going to be modest, but you're also going to be guaranteed a credit for the amount of inflation. So it will keep your bond portfolio of TIPS above the rate of inflation. And the third thing you can do when there's a high inflation environment is to look at commodities. Commodities are things like gold and silver, bullion, actually hard, metals and assets. Commodities usually do well in periods of high inflation. For each of these different types of investments, it's going to take some managing and some monitoring on your part, because as soon as the interest rate and the inflation environment is going to be changing, the value of the investments that you have in the portfolio that are acting as a hedge may actually turn against you if the market begins to do well and inflation begins to go down. Those assets are not going to be returning as much to you, and they may actually even start to decline in value. So if you're looking to use investment instruments as a hedge against inflation, you have to be mindful and monitor them and make sure to really manage your portfolio. My name is Julie Asti. I'm with Asti Financial Management, and you can learn more about my services or my company at www.astifinancial.com.